Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be going over our M1 Finance Roth IRA Monday buy. So every week I add brand new equity into the Roth IRA in order to dollar cost average, decreasing my unit cost, increasing my yield on cost, and increasing my dividend income going forward. Now, I forgot to record my video. It's actually fairly late here on Sunday. It's 12:39 in the morning, and I wanted to make this video really quickly, kind of recapping why I decided to rebuy my own stocks versus trying to go out there and buy into Kraft and Heinz. So currently we have again, if you are brand new to the channel, hit that subscribe button below. If you do enjoy the video, find it helpful, hit the thumbs up. And of course, if you have any comments, questions going over the stock market, personal finance, real estate, drop it in the comment section. I always appreciate all your guys' feedback as well as the thumbs up and those new subscriptions. And let's go ahead and get into it. So currently I have cash on hand of $9.08. This is from dividends from Caterpillar of $2.81. And we also had, so 281, whoops, that's 281, plus also on Monday of last week, we had AbbVie paying out $6.27 for a total, so $6.27, I believe it was correct, of $9.08. Now, AbbVie came in on Monday, but it did not get invested in my stocks on Monday because if you know, on M1 Finance, if you put it to buy $23.07, it'll specifically buy $23.07. And this is exactly how much cash we were calculating in our last week's video. It did not reinvest my $6.27, which is fine. I wanted to manually invest it myself. So it does exactly what I wanted it to do. Now, this week, that's why we have that $9.08 plus our $115.38 that we normally add into the market. Now, I add $115.38 over 52 weeks, which is basically maxing out the Roth IRA. Very quick and easy on a week-to-week basis, just adding that in every week, and eventually we will hit our mark. You can see here that as far as valuation here for 2019, we've already broke above, with tomorrow's contribution of $120 or $118.38, we're going to break above our $1,000 contribution for 2019 already. So we're on schedule there. Now, as far as our gains go here overall for the portfolio is actually done fairly well here. You can see the year return here, 1 year return up 10.51%. So that's fairly good over the last year. We are sitting currently around 8.28% with capital gains of 326.04 and earned dividends of 263.24. This is a more dividend-driven portfolio versus just following the returns of the market, but it seems to, keep up with the rest of the market. Now, you can already see here what stocks I've already chosen here. I have chosen Stanley Black & Decker, Lockheed Martin, Avery Dennison, Kellogg's, and Altria here. These are all positions here that are currently negative. And as far as the week performance here, we've actually had some good performance here within the last week. We had Altria bumping up 5.8, Main Street Capital up 5.2 or 5.72, Consolidated Edison up 4.57, Southern Company, and so on. So our only negative stocks this week were Cardinal Health, AbbVie, WP Carey, JP Morgan, Johnson & Johnson, Walmart, and Kellogg's here. Now, I would still like AbbVie to fall just a little bit more. AbbVie is not going ex-dividend. Again, it's not AbbVie. Where's my AbbVie here? It's not going ex-dividend until April. So I have about another month for this one to kind of continue to fall. If AbbVie can fall another, 5%, that would be offering a better opportunity. WP Carey also needs to fall a little bit more. And these other ones, I'm not too worried about where they're currently at. But other than that. Now, as far as what stocks I bought into this week and why I did not pick up Kraft Heinz. So I kind of reviewed all the stocks here that were in the negative. I looked at their financials again just to make sure, they were, the reason behind why I bought these is that they were all moving in a general direction of positive. Revenue, free cash flow, net income for all of my stocks here are generally, I invest in them because they're all moving in a positive direction. they may have some little lumps here and there, but for the most part, they have made some acquisitions here. Maybe Lockheed Martin, I have to look at this one, 2018. I believe they had some sort of a large acquisition, and that could be there. Avery Dennison here, free cash flow dropped sharply here in mid 2018. Probably have to look into that one, but for the most part, generally when it's a slow or a sharp curve, that's probably some sort of buy. Kellogg's here, slow moving there. Apple, we already know this one's crazy. Revenue, free cash flow, net income. Johnson & Johnson, Stanley Black & Decker. And then we have Kraft Heinz here with their decreasing free cash flow of 75%. And their net income is showing about 676% down into the negative just as of recent. So this could just be with their earnings and such. They're just not projecting very well. Now, as far as their valuation goes, when I looked at Kraft Heinz and I looked at their price to book, their PE ratio, their current buy price, in comparison to their 200-day and 50-day moving average, that you're able to buy it below the 200-day, 50-day moving average for the past 3 years. So this stock hasn't gone anywhere but down. You can see there's been a couple times here where it started to move back up, trended sideways, and just broke apart again. It caught another support here, trended sideways, climbed, and then just could not, and just kind of flustered out. And now it's way below. It's one of its lowest points here over the last. Oh, this is a brand new company. Yeah, that's right. They mixed here in 2015. So yeah, we're not going to have a whole lot of history here as far as anything prior to 2015. But you can see here, as of 2017, they've really just gone nowhere else but down. Now, PE, price to sales, price to book, and current PE ratio, this all looked fairly strong. Their price to earnings is 5.1, price to sales 1.6, and price to book 0.82. So when I was looking at these financials, the price, it actually looked like a good buying opportunity. But then I started looking at the return on invested capital. This was showing negative 10.71. If you look at any of my other companies here, they're all in the positive. They always have some sort of return of capital of in the 5 to double digits of the return on invested capital. Financial, AT&T, that's a slow, very slow company, but for the most part, all these other ones here, they have a very high return on invested capital, and this one just had a negative 10.71%. They also, if you're looking at their assets and liabilities, assets of 103 billion, liabilities of 51 billion. Anyways, that was one of the reasons here as to why I just was not wanting to begin investing in the Kraft Heinz. I feel like this one could continue to fall into the $20 range just with some time, as over their next earnings they just don't make any sort of progression. Yes, they cut their dividend, that should help them out, but they still need to turn their company around and show that they are moving forward, and that may cause them to break down into the $27, $23 point, which at that point they'll have a yield on cost of around 5%, whereas right now they're at around a 4.2, somewhere in that range. Now we can actually get their quick dividend here and actually just do a quick estimate. So their current dividend is 40 cents times 4, that's $1.60 per year. They're currently priced at $34.95. So that gives them a yield here of 4.54, that's just multiplied by 100, 4.57%. So anyways, without wasting much time, I ended up going with Lockheed Martin. This one's going ex-dividend here on February 28th. That gives me just this week here, I'm going to be able to go and use this capital, invest into the company. It's going to be getting the ex-dividend, and it's going to be increasing my dividends going forward. Kellogg's also down in the portfolio, going ex-dividend on March 4th. That's next Monday, so I'm going to be able to buy this one, go get those ex-dividends as well next week. Stanley Black & Decker also down March 4th, again next Monday. It's only 6 days away. Avery Dennison, March 5th, that's next Tuesday. And then Altria here should go in ex-dividend here in March 13th, so the second week of March. This Altria should be going ex-dividend here right along that time frame. So I've just been continuing to buy a little bit more Altria here while it is down in my portfolio now, and it has been making some really strong returns, which has been helping my portfolio kind of bounce higher here in the week. Here you can see a gain of 1.2%, up $148 for the week. So overall, pretty good returns there for that for the specific portfolio. And that is all I kind of wanted to cover in today's video, kind of going over what stocks I actually ended up buying, why I bought them. So you can see here, my main one here that I aimed to buy a little bit more of was Stanley Black & Decker. So this is not actual to correct, but I'm buying about $24.90 of Stanley Black & Decker, whereas all the other ones I'm buying about $24.89. So it's basically right on the line there, and that's going to give me, let's say, $115.38 plus $9.08. I'm going to be putting in about $124.46 into the market, and that's just averaging into these stocks here that are already negative in my portfolio, and just allow me to capture those ex-dividends here that are going here in the next week or so. So that is it for today's video. Just quick and simple why I am not invested in Kraft and Heinz, and which 5 stocks I'm actually buying this Monday. So that is it. Thank you all for tuning in. If you did enjoy the video, hit the thumbs up. If you have any comments, questions, drop it in the comment section below. And of course, if you are brand new to the channel, hit that subscribe button below. I do appreciate all your guys' feedback that I have been getting in the comment section. It's been fun to get other people's opinions, other investors' opinions of what they would invest in and why they wouldn't invest in companies that I'm invested in. And that is really good. I like to see that interaction, because my companies are not for everyone, right? Not everyone's going to go out there and feel the best buying a cigarette and alcohol company, or or Kellogg's, or a General Mills, or a Kraft and Heinz, where a lot of the millennial generation, I don't go out there and buy Oscar Mayer wieners or Kraft cheese or all those products, but I do like my Kellogg's. I like my oatmeal. I like my cereal brands. And those are still things that I do buy and enjoy. So that is basically it for today's video. I will catch you guys later, and have a great Monday. Bye.